Hello, this is Professor Berardi, and I'd like to go over bonds for our finance class. Um, a short version of bonds and give you an idea of how to do some calculations. So, I have this website that I can forward to you. It's a pretty good blog for finance students like us. And if you notice, it has a tab on time value of money, which you can read about, and it gives you some calculators as well. Bond valuation. The next class we're going to be doing stock valuations, which is very interesting. I know we all are very interested in stocks. Capital budgeting, risk and return. Here's our ratio analysis, which we just got done with. You can click on current ratio. It does the calculation for you. For example, current assets over current liabilities, and it gives you the formula and a nice description of what it is. So this is a pretty good website, I think, for learning. But to bonds, bonds are sort of a little more complex, but basically a bond is nothing more than a present value problem. That's all it really is. And so some of the components of a bond is the par or face value. Most bonds are issued at $1,000. So when you buy a bond, it's going to be quoted at a market price, but the company originally issued it for $1,000. So if a company issues a bond for $1,000, depending on what the market interest rate is at the time, that's considered the face value of the bond. When it matures, the company will have to pay the investor the $1,000 face value, regardless of whether the investor paid more than $1,000 for the bond based on market rates or less. So the face value becomes a lump sum payment at the end of the maturity of the bond. The coupon rate is the amount of interest that the bond will pay based on the face value, the $1,000. We all know that interest rates fluctuate up and down in the market when we go to buy our bonds, so the price of the bond gets adjusted up or down based on interest rates, current interest rates. However, the coupon rate is fixed. So when the company issues the bond for $1,000, let's say at $30 or 3% coupon rate, we're essentially going to get $30 a year in interest for that bond. It's fixed. So if interest rates go up, say 4% on a 30-year bond, and we bought a bond that has a coupon rate of 3%, well, guess what? Our bond at that particular time now is worth less than $1,000 in the marketplace because investors want a higher interest rate, and our bond is only delivering 3 when the market's demanding 4. So that's why bond prices go down when interest rates go up, and they go up when interest rates go down from our coupon rate. The coupon payment represents the periodic interest payments. Usually bondholders receive payments every 6 months, semi-annually. The maturity date represents the date the bond matures. Most bonds are long-term investments. They'll mature in 10, 20, 30 years. The original maturity, the time remaining until the maturity date when the bond was issued. A call to date means for bonds which are callable, and this is a feature on a bond. For example, if our company issues a 30-year bond with a coupon rate of 5%, and over a 10-year period since we've issued, that bond, the interest rate for bonds, a similar bond, are now 2%, which has happened in the past 10 years. Interest rates have basically nosedived to close to zero. What happens? Bonds want to be able to call, companies want to be able to call back that bond and basically reissue that bond again at a lower interest rate. It saves them money, cash flow, it saves them interest. It's no different than refinancing your mortgage on your house. When you buy your house, you lock in a fixed rate. Leave aside adjustable rates for the moment. You normally will lock in a fixed rate over 30 years. Well, let's say you bought a mortgage at 5% fixed rate, and then you experience what we've experienced in the last 10 years, where the 30-year rate fell to 3%. You essentially want to be able to refinance that mortgage and basically pay off your old mortgage, replace it with a new one at a lower interest rate. That lower interest rate will save you hundreds of dollars a month. Well, that's essentially the same thing why companies call bonds, to basically refinance. Obviously, when interest rates start going up, and that calling it would only cost them more money, they most likely will not call the bond if rates are higher. The required rate of return the investors currently require on a bond, so that's the current market rate. The yield to maturity is really the important feature here. It's the rate of return an investor would earn if he or she bought the bond at its current market rate and held it until maturity. It's essentially the discount rate in present value, which equates to the discount value of the bond. So in other words, the yield to maturity is basically the rate of return you, the investor, will earn on that bond depending on the price. Now, if you bought that bond initially when the company issued it for $1,000, chances are you paid face value, which is $1,000. If the coupon rate on that bond is 3% and you hold that bond to maturity, you're essentially going to earn a 3% yield to maturity. But if 10 years from now the interest rates go up and the price of that bond comes down, let's say you buy that bond for $990 and instead of the $1,000 par, the interest rate is still fixed at 3%, and now instead of having 30 years left on a bond, you only have 20, okay? The yield to maturity is now calculated and discounted to give you what your real rate of return as an investor would be. Yield to call is another yield that if the bond is called early and redeemed before the maturity date, essentially the rate of return that you've earned is recalculated because now your bond has been called at an earlier date. So you want to know what your rate of return is at that point in time. So there are different rates of return. There's the rate of return that you get if you hold the bond to maturity. There's a rate of return that you earn if you buy the bond at a different price than the par value or face value. And then there's the rate of return you get that if you bought the bond at any price, but it gets called. So here's a yield to maturity problem. Essentially, this is the formula, which is obviously much more complex for the average person to do, and even the calculator solution, a financial calculator, is complex as well, and punching in a lot of numbers on your financial calculator. So basically, the internet makes things very easy for us. So find the yield to maturity for a semi-annual coupon bond. Let's say you as an investor buy a bond in the secondary market for $862.35 for one bond. That bond was issued for a face value of $1,000. The coupon rate is 10%. There are 15 years to maturity. Therefore, your yield to maturity is 12%. This essentially is a present value problem. What's going on here is the calculator is taking the annual cash flows given off by the discount rate, which a coupon rate, which is $100, 10% of $1,000. So we're going to get $100 or $50 semi-annually, and we're going to earn a coupon rate of 10% a year. Okay, so those are our cash flows. Now, essentially, we are discounting those cash flows back to a present value. And then at the end of year 15, when it matures, we're going to get $1,000 back. Now, we know in 15 years that $1,000 is really not worth $1,000. It's worth less the discount rate. The discount rate essentially is the yield to maturity. So we're earning 12% on this maturity because we didn't pay $1,000. We paid less. So right there, there's a spread. We have a gain because we paid less. We paid $862 to get $1,000 back, which is a good deal. But keep in mind, we have to wait 15 years to get that $1,000 back. So the time value money discounts the face value. Also, the coupon rate at 10% on $1,000, we're going to get $100 a year or $50 every 6 months over the next 15 years or 30 payments times 2. That has to get discounted. Now, what happens if our bond price, we paid more for it, let's say $990? We're going to find that the yield to maturity comes down because now we're only getting $10 back after 15 years. So the discounted cash flow, we get less cash flow at the end of the 15th year. Let's say the coupon rate goes down to 6%. Essentially, we're going to earn a little bit better than the coupon rate, which is the difference really between the bond price and the face value. Essentially, the discount rate and the coupon rate are virtually the same. Now, if our years to maturity increase, let's say there's 18 instead of 15, okay, and we pay, let's say, $850 for that bond, we're going to do slightly better than the coupon rate. From an investment standpoint, you want your yield to maturity to be better than the coupon rate. If you can earn a better rate than the coupon rate, you're essentially getting the coupon rate and interest payments plus a gain between the face value of $1,000 and what you paid. So if we take a simple bond problem and figure out what the value of that bond is, it's fairly easy using the present value on Excel. So in this problem, we're told that the price of a semi-annual coupon bond, given that the coupon rate is 11%, the face value is $1,000, the required return is 6%, and there are 16 years remaining until maturity. So because it's a semi-annual payment, the coupon rate is not 11% in our Excel model. It becomes half, 0.055. The face value is $1,000. The required rate of return is 6%. Because it's semi-annual, it's going to be 0.03 in our Excel spreadsheet. With 16 years remaining times 2, because it's twice a year, there's going to be 32 payments. So if we plug this into our Excel and get to a present value, it's fairly easy to calculate. The rate here is always going to be the required rate, the market rate, because that's what we want to discount. It's not the coupon rate. It's what your expectations are in the market, that you could earn 6%. Because it's semi-annually, that gets divided by 2. The number of periods is 16 years. We have to convert that to semi-annual. So we're making 2 payments a year, so it's 32 payments. Notice this is number of periods, not years. As an investor, we're going to get a series of cash flow. That cash flow is essentially 11%, the coupon rate, times $1,000, which is $110 a year. But because it's paid semi-annually, we will get $55 a period. The face value is $1,000. As an investor, we're going to get $1,000 back at the end of 16 years or 32 periods. That's our future value. So the value of our bond, based on those parameters, is $1,509.71, which is right here, answer A. So we, in order, because the bond is paying 11%, but the market, in other words, if we go out and buy a new bond, we're going to get 6%, because that's what the required return is in the market. Therefore, the bond is a better deal. It's giving 11% coupon. The market is only giving us 6%. So if we buy this bond, okay, if we buy this bond, we essentially have to pay a premium for it. The face value is $1,000. We'll have to pay $509 over face value, because essentially the market is going to discount this bond based on the 6% premium. And we're going to be forced to pay more for that bond. Here's another bond problem. Find the yield to maturity on semi-annual coupon bond, given that the bond price is $7.90, the coupon rate is 6%, face value is $1,000, and there are 16 years remaining. So if we go to our bond calculation, if we go back to our quiz and write these down. So if the bond is $9.33, the coupon rate is 9%, the face value is $1,000, and there are 15 years remaining. Let's try to figure out the yield to maturity. So we're going to have to pay $933 for this $1,000 face value. The coupon rate is 9%, but it's semi-annual. So based on this example, I'm not sure if it already discounts for semi-annual, so I will take a chance and put 9% in there. And the years to maturity are 15 years. Let's see what it calculates. So it's saying 9.86% is yield to maturity. So let's stop and think. Basically, the bond is being sold at a discount to face value, which means that the yield to maturity is going to be higher than the coupon rate. Find the price of a semi-annual bond given that the coupon rate equals 9%, the face value $1,000, required return is 9, and there are only 5 years remaining. So let's put up an Excel spreadsheet and try to figure out the price of this bond. So a coupon rate is 9% on a face value, which means we're going to get $90 a year or $45 every 6 months. So our payment is $45. Our rate of return is 9%, which is the same as the coupon rate. So it's 0.045 because it's semi-annual. Number of periods is 5 years times twice a year is going to be 10. And the face value is 1,000. So we should basically be paying face value for this because the rates are the same. And it's answer C. So notice that the price of the bond in the market that we're buying it is the same as face value because the required rate of return is the same as the coupon. So there's no premium or discount. Now, if the required rate of return was lower than the coupon, then we're going to have to pay a premium. So if we say the price was not 9% but 8%, notice the price of our bond goes up to $1,040 instead of $1,000. So we're going to have to pay more because our interest rate that we require in the market is paying less. The bond's paying more on a coupon rate, so we have to pay up for that. Conversely, if the market was at 10%, we would discount our bond to $961. And therefore, your yield to maturity would most likely be higher than the 9% coupon rate. So that's essentially how bonds work. At first they're a little intimidating, but it actually becomes quite fun to do because it's just really a present value. And the nice thing about fun things about bonds is if you're smart, you're impatient, you can wait for interest rates to get to a point where you can start buying bonds at a discount, and you could actually make money if you buy right. So that's essentially a quiz on bonds, plus a little bit of a present value review as well. So thank you for watching, and we'll see you in class. Thanks.